Steve Leisman, CNBC. Madam Chair, as you know, inflation has gone up the last 2 months. We had another strong jobs report. The tracking forecast for GDP have returned to 2%, and yet the Fed stands pat while it's in a process of what it said it launched in December was a process of normalization. So I have two questions about this. Does the Fed have a credibility problem in the sense that it says it will do one thing under certain conditions but doesn't end up doing it? And then, frankly, if the current conditions are not sufficient for the Fed to raise rates, well, what would those conditions ever look like?
Well, let me start with the question of the Fed's credibility. And you use the word promises in connection with that. And as I tried to emphasize in my opening statement, the paths that the participants project for the federal funds rate and how it will evolve are not a preset plan or commitment or promise of the committee. Indeed, they are not even, the median should not be interpreted as a committee-endorsed forecast. And there's a lot of uncertainty around each participant's projection, and they will evolve. Those assessments of appropriate policy are completely contingent on each participant's forecasts of the economy and how economic events will unfold. And they are, of course, uncertain, and you should fully expect that forecasts for the appropriate path of policy on the part of all participants will evolve over time as shocks, positive or negative, hit the economy that alter those forecasts. So you have seen a shift this time in most participants' assessments of the appropriate path for policy. And as I tried to indicate, I think that largely reflects a somewhat slower projected path for global growth, for growth in the global economy outside the United States, and for some tightening in credit conditions in the form of an increase in spreads. And those changes in financial conditions and in the path of the global economy have induced changes in the assessment of individual participants in what path is appropriate to achieve our objectives. So that's what you see. That's what you see. Now, I guess you asked me also, what would we need to see to continue raising rates? And I think it's worth pointing out here that the committee, most participants do continue to envision that if economic developments unfold as they expect, that further increases in the federal funds rate will prove appropriate over time. Most participants anticipate that. And that the pace will be gradual. As I emphasized, most empirical work attempting to assess what the equilibrium level of the Fed funds rate is, a level that would be neither expansionary nor contractionary, those assessments are quite low at this time. So there is accommodation in the stance of policy, and we do expect over time that neutral rate to move up, but we're not positive what the pace of change of that will be over time. But given that the economy is now close to our maximum employment objective, hopefully inflation is moving up. I mentioned, as you mentioned, recent readings on inflation have moved up. There may be some I want to warn that there may be some transitory factors that are influencing that, but certainly our projections are for a gradual increase in inflation, and the committee, at least most participants, continue to expect that if we follow along this course, that some further adjustments in the federal funds rate will be appropriate but gradual.